Warren Buffett is one of the most successful investors of all time, with an estimated net worth of over $100 billion. His investment philosophy is based on 4 key principles, which have helped him to achieve his incredible success. We will explore Warren Buffett's investment advice for finding a good company to invest in and how you can apply these principles to your own investment strategy. Look for companies with a strong competitive advantage. One of the key principles of Warren Buffett's investment philosophy is to invest in companies with a strong competitive advantage. A competitive advantage is a unique advantage that a company has over its competitors, which allows it to maintain its market position over the long term. Buffett believes that a company's competitive advantage is a critical factor in its success, and that it is important to invest in companies that have a durable competitive advantage. Some examples of companies with a durable competitive advantage include Coca-Cola, which has a strong brand and distribution network, and Amazon, which has a dominant position in the e-commerce market. When looking for companies with a strong competitive advantage, it is important to look for companies that have a unique product or service, a strong brand, a large and loyal customer base, or a significant market share. These factors can help to ensure that the company is able to maintain its market position in the long term. Invest in companies with strong management. Another key principle of Warren Buffett's investment philosophy is to invest in companies with strong management. Buffett believes that the quality of a company's management is a critical factor in its success, and that it is important to invest in companies that have competent and trustworthy management teams with a proven history of success. When evaluating a company's management team, Buffett looks for managers who are honest, competent, and have a long-term perspective. He also looks for managers who have a significant stake in the company, as this aligns their interests with those of the shareholders. Buffett has said he would rather invest in a mediocre company with great management than a great company with mediocre management. This is because he believes that a great management can turn a mediocre company into a great one, while a mediocre management can ruin a great company. Invest in companies with a consistent history of earnings. Another key principle of Warren Buffett's investment philosophy is to invest in companies with a consistent track record of earnings growth. Buffett believes that companies that are consistently profitable are more likely to continue to be profitable in the future, and that it is important to invest in companies that have a track record of success. When evaluating a company's earnings history, Buffett looks for companies that have a consistent track record of growth rather than companies that have had a few exceptional years. He also looks for companies that have a strong balance sheet and a low debt-to-equity ratio, as this indicates that the company is financially stable. Invest in companies that are undervalued. The final key principle of Warren Buffett's investment philosophy is to invest in companies that are undervalued by the market. Buffett believes that the stock market is not always efficient and that there are opportunities to buy great companies at a discounted price. When looking for undervalued companies, Buffett looks for companies that are trading at a lower price than their intrinsic value. He believes that by buying undervalued companies, he can achieve a higher rate of return over the long term. Warren Buffett's investment advice for finding a good company to invest in can be summed up in a few key points. He believes that it is important to invest in companies with a strong competitive advantage, excellent management, a consistent track record of earnings growth, and that are undervalued by the market. By following these principles, investors can increase their chances of finding high-quality companies that can generate strong returns over the long term. However, it is important to note that investing in the stock market carries inherent risks, and investors should always do their own research and seek professional advice before making any investment decisions. In addition to these principles, Warren Buffett's investment philosophy is also based on a long-term perspective. Buffett believes that investing is not about making quick gains, but rather about making sound investments in high-quality companies that will generate strong returns over the long term. One of the key advantages of investing in high-quality companies is that they tend to have a durable competitive advantage, which allows them to maintain their market position over the long term. This means that investors can benefit from steady growth and a reliable stream of dividends. Another advantage of investing in high-quality companies is that they tend to have a strong balance sheet and low debt-to-equity ratio. This means that they are financially stable and can weather economic downturns more easily than companies with a high level of debt. In conclusion, Warren Buffett's investment advice for finding a good company to invest in can be summarized as follows. Look for companies with a strong competitive advantage, excellent management, consistent track record of earnings growth, and that are undervalued by the market. By following these principles, investors can increase their chances of finding high-quality companies that can generate strong returns over the long term. If you found this information helpful, please consider liking and subscribing to Cash Bites for more investment tips. Thanks for watching.